Hello, everyone, and welcome to another live episode of The Yield. Be sure to subscribe to the show on Apple Podcasts, Spotify, or YouTube, and leave a review if you're enjoying the content. In case we haven't met before, I'm your host, Peter Kerr, and I'm the Director of Product Marketing here at Yieldstreet. Today, I'm joined by Damion Lupo, best-selling author and founder and creator of eQRP, the ultimate investment retirement tool. Damion, thanks for joining us today.
Peace, good to see you. Thanks for having me.
Yeah, of course, we're excited. But perhaps maybe for some of our listeners who are less familiar with yourself and eQRP, maybe you can start by introducing yourself and sort of how you came about founding the company.
Yeah, this was a big transition. I started off 20 years ago investing in real estate. That was really my bread and butter. I started off buying a bunch of houses, ended up with 150 houses and some other investments. I built condos and apartments, and ended up losing about $25 million in 2008. And on the other side of that, decided I was going to do something a little bit different. A little bit gun shy with real estate for a little bit after you lose that much money. And
I can only imagine.
Yeah. So I said, okay, what am I going to do? And I noticed that there was a huge gap in the retirement space, and watching my parents both retire basically broke, following a system that doesn't really work for the masses. It really works for Wall Street more than anything. And I started digging into it. And about a decade ago, I created something that gave people what we think is real control and of their retirement money, because that's where most people end up with most of their liquidity. And so that's been the journey the last 10 years is showing people, educating people, and giving them actual control of their retirement money through the eQRP. And that's what we do now. Really, that's the focus, is giving people control and giving them choices that are outside of Wall Street.
Well, I'm curious. You say, outside of Wall Street, and that, obviously the system is designed to support Wall Street. I'm curious if you could elaborate on that.
Yeah, I mean, really, when we think about retirement, most people think about 401ks. They think about something that was at a company or the government. They had an option for some mutual funds and maybe some bond funds. And all those systems are really built for Wall Street to profit by just having assets under management and getting fees. And at the end of the day, people realize that the compounding has been used against them. Jack Bogle, the founder of Vanguard, that just passed away, made a comment. He said, something's wrong with this in a system where the people take up all the risk and they end up with about 20 to 30% of the return. And that's the system that's in place. But the system also allows people to have a lot of control so that they can do alternatives outside of mutual funds, where they can do private notes, they can do real estate, they can do gold, crypto, meaning they can have Main Street assets and work with Main Street people so that everybody's getting wealthy together, not just the folks in New York.
Yeah, I'm only curious because I guess perhaps I'm not following fully, but you say only 20 to 30% of the returns. In most traditional, like 401ks, for example, you're talking about, oftentimes index mutual funds, but also certainly some active mutual funds as well. Obviously, ETFs not really allowed in 401ks yet. But when you say only 20 to 30% of the returns, what do you mean?
So what happens is there's a lot of fees and things. So when you see the surface level fees with many mutual funds, in fact, they all have things that they have to disclose, but then there's actual costs on the other side. And when Bogle, who ran one of the biggest brokerages in the world with Vanguard, these were his words. And it was because he understood the system that had all the fees that were invisible, that weren't required to be talked about or put on disclosures and things. And so it's a combination of the fees, and it's also the taxes that most people pay. So at the end of the day, people were ending up with about a very small percentage of what they thought they were getting. And it was just a combination of everything that was really invisible.
But so like in that example, if there's, let's say like, the Vanguard total return bond fund or equivalent, right? That's meant to, track one of the largest, fixed income benchmarks in the world. Mm-hmm. And let's say it's yielding, I'm just making up numbers here, but let's say it's currently yielding 2% or so. Those funds typically have, in the case of Vanguard, a couple basis points worth of fees. Where are the rest of the fees going?
So there's marketing and admin fees that are put on the backside. If you dig deep into prospectuses and you dig deep into the actual financials, there's costs in it that are associated that are blended in that are not. It's not a typical percentage that you're going to see that it's a basis point or two. The surface level stuff tends to be really low, and that's what's advertised. But you have to go deeper into the materials to see the other charges that are there. They're there. They're just not visible.
So how does eQRP sort of help, investors, let's say, have, at least see more transparency in your mind?
Well, it really gives you choices, so you can still do all the same things that you might want to do with the mutual funds or whatever, but you've got the option to invest in everything else that's out there. Because the way the laws work, it's the IRS basically says you have these things you can't do and anything else you can do it. So if people say, I want to invest in apartments, or I want to invest in private notes, or they want to invest in physical gold, all these things are on the table. Island property in Belize, just really anything under the sun. And because you're in control of your retirement money, you can choose those things. Most of the time, what happens is people have retirement accounts, 401ks specifically, where somebody else is telling you what the choices are, because it's a structure for them to maintain control and make it easy for them, and then having fees coming in off of all those assets under management. So the eQRP is really just about you having the absolute choice in what you want to put your money in, which is really almost anything.
Yeah, I'm curious. So in terms of like plan administration, right? Like, how do you guys think about it in terms of, or what do you think the argument is? With knowing that there's, some behavioral science that says too many options, create some decision paralysis. And that's one of the reasons why some of these administrators, especially move towards target date funds, right? To help reduce, some of the friction just to get people even invested into 401ks and help them actually save for retirement. And then on top of that too, what do you think about it in terms of, the liability of having on behalf of some of the, plan administrators, in terms of having too many options that maybe aren't as well vetted or well known? And so reducing some of those choices so they can go deeper on a more select number of products, and sort of reduce some of the ones that maybe have unintended risks that maybe they're less aware of if the program menu is too large.
Well, what I would say is that most people are probably not going to be good candidates in general, because either they're too busy or they get overloaded. They won't do anything. So for things where you actually have all control, whether as an employee or a business owner, it's a different mindset. It's somebody that says, I'm going to take responsibility for all this, and I'm going to spend a lot of time getting educated. Most of the population, unfortunately, is just not going to spend the time. So having a limited number of things that are basically sanitized, where it's something. I mean, I will definitely agree that anything that somebody does over nothing, if they invest in mutual funds and they wouldn't have done anything, that's great, because nothing is a disaster. And so this is really meant for people that say, okay, I'm going to invest the time. And for administrators, people that have companies, they've got employees, there's no liability. If you've got options, you've got mutual fund options, and somebody says, I want to do a private whatever, and they invest and they lose money, there is no liability on the administrator, because it's the choice of the person, and the laws protect the administrator. But the bottom line is you want people to have good options and not do something stupid. So what we'll generally find is that most people, unless they're going to spend a pretty significant amount of time being educated and being a self-study, they're pretty much going to default back into mutual funds that are, the time type of, the target date ones, really simple stuff. And so people sort of self-select, but I believe that people are smart enough and are going to care about their money more than Wall Street will. Wall Street cares about the fees, but they don't care whether somebody gets rich or goes broke. That's really not their thing. Individuals care. Like, I'm going to care about my money more than anybody else. And I would expect you or anybody listening and watching, same thing. And this just gives people that option.
But don't a lot of the fees, aren't they based in percentage terms? So as assets grow, and obviously performance largely driven by flows as well as returns, don't you feel as though they're more aligned maybe than just, hoping that, not caring about performance overall? Because don't they eventually, over time, if performance does lag, eventually, while they might be slow to move, I completely agree with you. Don't you feel as though plan administrators, if performance does decline or, deteriorate or underperform for long enough periods of time, don't they rotate out of those managers?
I mean, when you're talking about big, people generally aren't moving, bouncing around. And I'm talking the masses. People tend to just stay in things that it's a lot of S&P type of funds, so they just sit there, and so there are these fees. When people, if there's an alignment of performance, that's one thing. But what I'm not a big fan of is when people aren't really actively doing something as a manager, and their fees keep continuing to compound. And so I have a problem with that system, because it's always in favor of the advisor. But an advisor that has an alignment, like if we have a deal, and there's the majority of what we end up with is based on the performance, like hedge funds with their 20% of the profits. I like when you have a lot of the actual gains for the advisor or the manager. I like it when they're aligned with the actual profitability. That just seems like a better alignment from my perspective.
Okay, cool. And then so maybe you could talk us a little bit through, and like we talked a lot about 401ks, but I imagine you guys aren't really offering 401ks. It's a lot about people maybe who have had a life event and transition away from an old job and went into retirement, or perhaps even, have sort of an in-service rollover option for their 401ks. But who are the types of people that would benefit from using your product?
So that anybody that's wanting to do something other than mutual funds, like we're not really going to be helpful. It's not really going to be really useful for somebody to have an eQRP unless they say, okay, I want to do something alternative. An individual that leaves their job, or they have a business up to 50 employees and says, I want to do something that's not just mutual funds. Those people get a lot of benefit because they can actually move between asset classes, and they've got a lot of control to put a lot of money in. This compared to maybe an IRA where you can put $6,000 in a year, doesn't really move the needle very far. Whereas here you can put almost 60,000 a year in, and it can be deferred or Roth. You've got a lot of options there. And so it's the type of person that this is interesting to is somebody that says, I want exposure in something other than just mutual funds. Like I need beyond paper assets. And when they leave a job, usually it's when they leave a job, they'll have access to it. And people that have firms where they have their own 401k, because the eQRP is a type of 401k. It works whether you're an individual or you've got dozens of employees. It works the same way. You have the ability to invest how you want to. So it's really more of the person that says, I want to do something else and I want to control my money. It's not like this is just for doctors or dentists or, it's more of a mentality that this applies to.
So you mentioned that, the eQRP, has contribution limits that are significantly higher, it sounds like, from traditional IRAs, and even in many cases, 401ks, although it depends who's kind of contributing. But to that point, maybe you can just elaborate on, who would be eligible for such a product, and really kind of help people understand why this product exists when they feel so constrained or limited with their IRA or 401k contributions.
Yeah. So, I mean, I think people feel constrained in general because they have this certain box and they think that that's the only box that exists because that's all they've heard about. For years, all I knew about was an IRA, and that was a great product, and I used it, and I still have one, and that was good information until I learned more. There's like this whole vast architecture in the IRS code of things you can do, and so when people are trying to figure out, am I eligible? Like, how do I even do this? It's really, you have to have some type of business activity. And so you can be an employee, you can have your own business with employees. Like really, you've got to have something. And so we have a lot of people that are doctors or they work for the government and they have a very minimal side hustle, if you will. They're out there, they're maybe looking to flip properties. They drive an Uber, they have a lemonade stand, they're online digital marketing. There's a lot of different things that can be done. Anything that you do that's not just a W-2 would be eligible to qualify you to have an eQRP, or your company to have an eQRP. Companies will switch their 401ks to eQRPs because they want to give everybody control, especially owners that have a lot of money trapped inside these plans.
Yeah, so I think what you're saying is like, right, what someone could even perhaps have, a W-2 type employment opportunity, but certainly if they had to do something else, as an outside business interest or like, they can certainly find ways, to structure it so they actually recognize as a business owner a lot of the additional tax benefits and retirement benefits that maybe they wouldn't be subject to if they just went through their W-2.
Yeah, exactly. That's exactly right. Couldn't have said it better.
Yep. Yeah. Thanks. Don't want to take your job for you. So I think people are now starting to understand, what the overall structure is, right, of this account. I guess my question is, certainly through, eQRP.com, your company, what type of investments can they access, and how else should they kind of think about what their opportunities are, maybe outside of stocks and bonds?
Well, and just a clarifying thing, it's eQRP.co, or they're going to end up in a Chinese website that doesn't have anything to do with us. No, it happens. It's the cyber squatters that like to steal things, but another conversation. Really what we see most often is we see people focusing a lot of energy on real estate activities, and there's more and more interest in the crypto space. There's some things that can be done in crypto. Especially the reason this is becoming interesting is because you can have a Roth account where all these potentially exponentially growing assets can be tax-free for life. And that's why it's so interesting, because there's no other way to go, say, buy Bitcoin for $6, it turns into 60,000 and not pay taxes when you sell it. But you could do that inside of a Roth eQRP. So people are doing a lot of crypto stuff. They're doing, they're putting oil and gas, they're putting all sorts of stuff in here. A lot of private paper. So when I say that, I'm talking about the private notes. People are doing a lot of note trading, because when you think about notes, one of the problems with notes is that there's no tax advantage like you have with real estate with depreciation. And so you want to try to find a vehicle that allows you to have that income and potentially do it tax advantaged or tax free. So those are the main ones that we see people putting into their eQRPs is really the real estate, the crypto, the gold, and private notes.
So I guess maybe my thought to that then is just to get an understanding of, how people move the asset into the account. Is it all facilitated on your platform, or do you really just house, again, the account type for which people have to take some private assets and reassign to the account, maybe, through documentations as opposed to a digital platform?
So it's a combination of both. Some of the assets are part of the platform, and some of them for real estate, or it could be notes. Physical metals can be held by the person on behalf of the retirement account. Same with cryptocurrency. So it's a variety depending on whether the asset is digital or whether it's physical. So they've got flexibility to hold things, to assign it to a portal. I mean, there's a lot of flexibility. It's not really a one size fits all, because different people have different needs. One of the examples, some people want to hold their metals personally, some people want to put them in a vault, and some people want to turn them into crypto, like, a crypto gold versus a physical gold. So it has the flexibility to do really whatever somebody wants to.
Very interesting. And just as far as just understanding, how someone assigns an asset to the account, is it as simple as just, again, provide some paperwork to some to some lawyers, or is there some, capability that you have on site or on platform that really helps make it easier?
So it's a combination of our platform and our team that does the conversion with titling and moving assets around between wherever they are. If they're in an IRA or if they're in a 401k, moving those assets, working with sponsors, working with lenders. So we do all the legal work to make sure that things are transferred. But it again, it depends on what the asset is and how we move it. But we take care of the moving so that people don't get lost in the morass of trying to retitle stuff.
Yeah, and I think one of the things that I know people get very challenged and frustrated with is it seems like at least every 4 years, we'll say, it seems as though there's going to be an update to some policy changes to loopholes, different types of accounts, and the like, as obviously governments look to recoup maybe some revenues that are maybe being untapped, or revenue streams rather. So I'm just curious, one, any insights into sort of what's going on in regulatory front, and then two, do you think that obviously it probably sounds very attractive to a lot of our listeners? There's any regulatory risk that these type of retirement accounts face?
Well, what's interesting, we saw this recently with the proposed changes. We had the biggest proposed changes to retirement accounts in history, and this was part of the reconciliation and the infrastructure bill. And what has become really obvious is what Congress giveth, Congress can and will taketh away. And so what you can anticipate, and people say, well, what's the risk? I'm like, the risk is we have humans called Congress people, and especially Democratic ones that want to try to take money from people that have money. Well, if you're building up big retirement accounts, Peter Thiel has a $5 billion Roth IRA, and Congress, like AOC, said, well, let's go and take that because that's just not fair. So I think that there's going to be continued, regardless of what passes right now, there's a threat specifically against IRAs because people have been smart. Like Peter Thiel took $2,000 22 years ago, turned it into $5 billion. Mitt Romney has hundreds of millions in his. A lot of people have big money and they're not paying taxes. Like Peter Thiel will never pay taxes on that $5, which will probably turn into $50 billion. And so what I would tell you is that it's always going to be looked at, and the laws will continue to change. The thing that's being scrutinized the most right now is the IRAs because people have been abusing them. And so Congress is going after where they abuse them and where people are building up these giant accounts because we have a progressive agenda going on. So you don't see the attacks going after 401ks, eQRPs, but there is an attack on wealth. And there's definitely one on the IRAs that people have been abusing. So unfortunately, if you have an IRA and you're playing by the rules, you're still blobbed into this thing. Well, hey, we need to fix this and restrict it. And the restrictions that were being proposed would have limited people that have self-directed IRAs from really only doing paper assets. They couldn't have done private companies. They couldn't have a single member LLC. They were very limited. They couldn't have over 10 or 20 million without distributions. There were a lot of restrictions that were being put in place because of the politics. Didn't make any economic sense, but the politics. So I think that's always got to be something that people consider. And when somebody says, well, what's going to happen? I have no idea because it's all humans. It's not like I can tell you whether gravity is going to be on or off next year. I know that, but this is politics. Who knows what's going to happen?
No, very interesting. I mean, I think also, one of the questions, we see most often out in the market is also, just making decisions about, when to pay taxes on certain tax deferred accounts, right? Whether the Roths of the world are now better because rates are going up later on. So take, your current tax rate and assume, you had 5 or 10%, 20 or 30 years from now at retirement, or also something like, a traditional 401k or the like, where you're deferring your taxes. I guess maybe can you explain, when the taxes come into play for these type of accounts?
Yeah, it's a really important question. I'm glad you brought it up. When you're thinking about deferred or Roth, one of the things that comes up is people say, well, I don't want to pay taxes, so I want to have a tax deferment. So they'll put money into a retirement account, they get a tax deduction. The problem is down the road when all that money is growing and you take it out, you're getting taxed at ordinary income. So it's not even capital gains, it's all ordinary income and it's on everything. And typically the pitch is, well, you're going to be in a lower tax bracket. I think that's fundamentally the dumbest thing I've ever heard, because you're saying, let's plan to be broke when we get older. So the idea is you have more and you're going to end up making the most down the road. So what you want to do is make sure that you're paying zero tax. I believe it makes more sense if, especially like you mentioned, in a likely scenario where tax rates are going up down the road, it makes more sense for us to pay the taxes now. So down the road, we're at zero. We don't care if the tax rates go to 39, 40, 50, 70. I mean, they were upwards of 90% in the progressive brackets in the 1950s. So who knows where they're going to be down the road? It's pretty unlikely they're going to be lower. I think most people would agree that's very, very unlikely. And that's a reflection of the amount of debt that has to be paid and serviced. So paying now, using the Roth, is what I would say mature adults do. And I think immature people that are trying to just pretend that they're not going to pay taxes use deferments, and they don't really think about the big picture.
It's always tough too. I mean, and part of that also has to come down to contribution limits and everything else that do play a factor into it. But certainly, I think it feels likely that at least in the near term or medium term, let's say, tax rates probably have to trend a little bit higher. Then the question becomes, for some of those with different horizons to their retirement, expecting to work until they're 70 or 80 now, certainly, hard to prognosticate that far out.
And that's just one last thing on that. I would say that that's one of the best things about going to zero with Roth, because you don't really even care what happens down the road. It's fairly unlikely that all of a sudden, and this is also possible, Congress could say, well, we're going to change it. You've already paid taxes, but we're going to charge you taxes again. Could happen, but it's fairly unlikely, and it just protects you from the tax rates and the tax creep.
So then, obviously everything here sounds incredibly interesting, I'm sure, for our listeners. I'm curious to say, or to learn, what are some of the downsides of this type of account relative to others?
Well, I think something you brought up earlier, which is a really good point. Like there are financial professionals, and now some of them don't act very professional, but there are professionals that are on the other side of management. If you have say a traditional type of asset here, if you go out and you invest in real estate or you do something stupid, there's nobody protecting you from your own dumbness. And I speak to my own dumbness from back in the early 2000s when I lost the 25 million. So it's not hard to lose money if you're just out there being reckless. The downside here is you can be reckless and nobody's going to stop you. And so I think that's why it's really about people that are self-responsible. And if you're a good victim and you know how to blame and justify, this is probably a bad idea, because you're going to end up doing something to shoot your knees off.
Well, I guess my question is in that regard, is that specific to the account, or is that just specific to, again, essentially becoming an investor outside of, on your own terms rather?
I think it's an investor outside. I think that's a good point. Yeah. It's just when you have traditional stuff, people are locked into like one of 5 mutual funds. And so not a whole lot you can do to completely blow up your system or lose all your money, but you could definitely do that in anything if you're out there just throwing money. I mean, I've lost everything 3 times. I know what it's like to bet and go, oops, and then it's all gone. That's pretty unlikely in a place that's managed and sanitized. And that's really how I look at Wall Street. It's very sanitized so that you're probably not going to lose all your money. Markets go down, but you're still going to be there with capital. That's not the same thing if you go and do things in the wild.
So one of the questions that we came in that's come in so far is someone asked if they can move an existing 401k plan from a former employer into an eQRP. I assume the answer is no, just given again the whole W-2 nature.
So you can you can move old 401ks, you can move old IRAs. The only thing that you can't move is a Roth IRA or an inherited IRA. Those are 2 things that are stuck where they are. Everything else can be moved over. Sometimes even while you're working, like you had mentioned something almost nobody ever hears. It's called in-service rollovers. And so that's something you could do if you were still working, sometimes, pretty rarely. But anything from an old retirement account, whether it's a TSP or a 401k, and you've left that job, you can roll those into an eQRP, and then you have the control. So pretty open right now to be able to do it.
Well, I guess. So sorry. It's probably you're eligible to roll it over, but any future contributions must come from outside of a W-2 and must be through, again, an ownership stake in a separate company.
That's right.
Okay, very interesting. The next question that came in was around, is it possible to 1031 a rental sale into an eQRP?
No, because when you have a 1031, you're going to have it owned by you or an entity. It's not going to be inside of a retirement account. So assets that move into an eQRP have to be owned by another retirement account for that actual transfer. It can't be you owning something personally. 1031s are really from you to you, or an LLC to an LLC. It's really always staying the same. So you always think about assets being owned by something in a silo, and that silo is pretty rigid. So that you can't self-deal move assets into, and so that just you could move cash if you were able to contribute it, but assets by themselves that are owned by something other than a retirement account would not be able to be put into any type of retirement account.
Yeah, that makes a ton of sense. Another question that came in asked if Yieldtree and eQRP are partners, and does an investment in one give you access to the other? So at this point, we are not partners. Yieldtree does offer an IRA option for those that do have an IRA that they want to access private investments in. Certainly, I'll say on behalf of Yieldtree, we're always looking for new partners and new ways for us to, again, provide alternative products to our investors in essentially as many count options as we can. So maybe that's something for Damion and I to talk once we're off the live webinar.
Yeah, and it's really important for people to do their own education, and to study and to really poke around, because like it doesn't matter who's talking. There's always more information, and I'm really well versed. I've been doing this for 10 years, and I've written books, and I learn new things every day. And so it's just important to not feel like that the education stops. Like I'm glad that you guys are doing what you're doing, and people just need to realize that nobody's going to care about your money more than you are. Like you really got to go out there and protect it and learn and educate yourself.
Yeah. Hopefully everyone is always, again, continuing to grow and expand and learn more. Certainly, I imagine perspective helps a lot. And I guess kind of one thing that comes up to me there is, you've talked quite a bit about some failures, or at least some money lost. What have you kind of learned along the way with some of those experiences?
The biggest lesson is that your money is not you. It is a reflection of labor, but it's my biggest takeaway after I lost all that money and went from 20 million in assets to -5 and had to start over. I was a walking, talking balance sheet. And when money goes, if that's all you are, then your self-worth is basically destroyed. Your self-concept is whacked. And so I had to start looking at money a little bit differently. That it was a reflection of activities. It was a reflection of impact and what I was doing for other people. And that was the big switch. So instead of me just trying to figure out how to make more money, it was how do I make more impact on more people? And the money ends up being a side effect. So I needed to lose repeatedly and get my brains beat in so that I could get that. There's no way I was going to get that with success. Success is kind of a terrible teacher. So I needed to be popped in the head and learn by bleeding and going bald. It was really helpful.
I saw the hat. For those that are just listening and not seeing audio, Damion is wearing a hat. Now we know why.
Exactly. Hey, it's cold, man. I mean, this is fall. I got to have a hat for these bald heads.
There was a follow-up question to, the partnership or potential partnership between Yieldtree and eQRP. And so the follow-up question was, so what is the difference between an eQRP and a self-directed IRA?
Well, big picture, there's a custodian in an IRA. There's limits on what you can invest in specifically. Some of the stuff is the same, and then there are some differences. The amount of money you can put into an IRA if you're contributing is 6,000 or 7,000, whereas an eQRP, it's 60, could be 100, 200, depending on if there's multiple people in a household. Doesn't matter how much money you make. IRAs have some restrictions on if you make too much money, you can't put money in, or you can't do Roth, and you don't have any of those restrictions inside of an eQRP. There's one of the biggest ones for people that are looking at real estate is that eQRPs are exempt from UBIT. It's the unrelated business income tax that gets triggered when you have leveraged real estate or leveraged activity. And IRAs generally will be subject to that when there's a net income event. So there are some distinct differences. And then there are some things that are the same, like prohibited people you can't do deals with, or prohibited, you can't buy a house that you're going to spend the summers in a retirement account. So they do have some similarities. The big picture that anything you can do with an IRA, you can do with an eQRP, and you have a lot more control, and you don't have a custodian, which sometimes it actually is a good thing. You have somebody checking your paperwork, but there are very big differences. And so, one thing you can definitely do is grab a copy of my book. And I do talk about that quite a bit, and happy to give everybody a copy of that.
But I guess, the fault of that, right? Like you talked about the benefit of a custodian. I guess there's also some benefit, I imagine, at least for, an IRA or other, more traditional ERISA accounts, as far as in terms of reporting, right? So I guess as far as, the eQRP, what type of burden is put on, the individual in terms of reporting, either asset valuations, anything along those lines, that maybe make it a little bit different than actually investing in something else that has an ongoing performance update that can be provided?
Well, anytime you have any type of assets that don't have a market value every day, stocks, cash, those type of things. If you have the real estate, you have notes, you have gold, you have whatever, those things require evaluation every year. And that's the same for IRAs, 401ks, eQRPs. They all require that. The actual filings that's what we do. We provide all the compliance filings, and in a lot of cases, we'll do evaluations or have sources for valuations. But they all require it. The IRS wants to know how much is in these accounts, and so there are appraisal requirements for any type of asset that's floating around. If it's not liquid, if it's not a brokerage account, there's going to be some type of third party. With real estate, it's fairly simple, and it's evaluation by a third party. That third party could justifiably be Zillow, Redfin, and something else. I mean, you can take things and compile the data. You don't necessarily have to go out and spend thousands of dollars on an appraisal. It just has to be done, and then the question is who's doing it. And so it's definitely on the investor to be responsible for it. And then in our case, we do a lot of support with the filings and also some of the resources for providing those appraisals for the alternative assets.
Okay, great. We're just getting past 4:00 here, so we are going to look to close out. It does look like there's another question, and then I have one more question on my own. The follow-up question was, do Roth IRAs have an annual contribution limits within the eQRP? So maybe you can just quickly help explain that again, the difference in accounts.
Yeah, so Roth IRAs have a limit on what you can put in, and you have a limit if you make too much money, you can't do it at all. You'd have to do some maneuvering with after tax money. But with a Roth eQRP, there is no limit. It's 10 times as much. You could put 58,000 or more into it each year. And so whether you make $1 million or 100,000, you'd have the ability to put that full 58,000 into it. But so bigger options, about 10 times as much.
All right, I'd take it back this time. This one's the last question. So the question is whether or not, if you were to roll a 401k into an eQRP, can you then convert it into a Roth, and sort of what would that process be, and what are some of the tax implications?
Yeah, it's one of the greatest strategies right now to move money from IRAs and 401ks into an eQRP and then convert it to Roth, because at that point, you're able to take any of that money out. Once it's converted, you can take it out, no tax, no penalty. And when you convert it, that's a taxable event, but then that could be offset by depreciation and different things. So potentially you could convert up to $500,000 a year right now. If you were a spouse or a real estate professional, you could offset it, pay no tax on the conversion, and have access to that whole 500,000 every year. You could do this. That would give you the ability to take that money out at any age, no tax, no penalty. So there's some really interesting strategies because of the tax code the way it is right now. And we do that all the time because paying no tax beginning, middle, or after is kind of the best option.
And then so along that line, do you think that's a loophole that gets closed? And maybe you can also offer any ideas on what you think, sort of the regulatory changes might be over the course of the coming, 6, 12 months or so, as you see them today.
I don't think we're going to see much of anything happen over the next 12 months because we have an election year coming up, and they're not going to go blow this thing up. They're going to pander to voters. This isn't something that a lot of people are doing. It's something that sophisticated real estate investors are doing, and that's a smaller portion of the population. So I don't see this as being a big target. They have a limit, so you can only do $500,000 per year by cross mixing these different, the offsets from income and the expense from the depreciation. So it's not like you can do an unlimited amount. But you never know when things are going to change. I don't see that happening next year, and I highly doubt it's going to happen the next couple of years because we're going to be into another presidential cycle. So this was kind of the big one. They do this the first year after an election with a new president. The administration says, here's our policy. Here's what we want to do. So it's likely to be a target if it gets too big, but I think that's years down the road. I think there's other stuff they're going to go after. This is not something I'm really that concerned about. But then again, you know what? I don't want to bet it's going to be there in 5 years. I want to use it now. And I would suggest people use what they can now before they just blow up.
That's great. This has been a great conversation. Damion, I do want turn over to you, see if any closing remarks, and then after that, we'll close out. But everyone, thank you so much for your participation.
Yeah, I would just, I'd say that the best thing you can do as an investor and an investment is educating yourself like you're doing now. And one of the ways I can do that is give you everything I've got. So everything I've got, can I give you everybody a copy of the book? Is that all right?
Sorry, do you mean the title, or you're going to physically give everyone a copy of the book?
No, I mean, I'd love to give you guys a chance to just get a copy of it. Well, there's some, if you go to, if you go to eqrp.co, you can get a copy of both the book and a summary of the book. And so just go there. It's on me. It doesn't cost you anything. And I'd really encourage you guys to stay in this education flow and take a step, because ultimately that's the differentiator. It's, are you educated, and are you used to taking action? So eqrp.co, you can get a copy of that book, the QRP book, and you can also download the summary of it on your phone in about 5 minutes.
No, that's good. And we certainly encourage everyone to do it. And I think what you said there at the end was very interesting, right? Like the opportunities are roughly equal, give or take, for everyone. So what people always need to remember is that there's just some people taking advantage of certain opportunities that maybe others aren't. Sometimes just a lack of awareness that it's around, but certainly there's something to be said about further educating yourself so you can identify those opportunities that maybe are a little bit more apparent or, right in front of your face, more or less, that maybe you wouldn't know were available to you.
100% agree.
So with that, I want to thank you all again for attending today. Damion, of course, thank you for joining us. To listen to other episodes of The Yield, please visit and subscribe on Apple Podcasts, YouTube, and Spotify. For any other questions on Yieldstreet, please visit www.yieldstreet.com or email us at investments@yieldstreet.com. Thanks so much.